Now, will Snap's IPO live up to the hype? Investors won't know until the stock starts trading on Thursday. But for Wall Street, the question has already been answered, and the answer is no. Bloomberg's editor-at-large, Erik Schatzker, is here to explain. No, Erik, why?
Mark, Vonnie, it may surprise you, but the reality is giant IPOs like Snap aren't a great business for Wall Street, and that's mostly because the fees on these big deals are so low. Long gone is the fixed 7% commission on IPOs. These days, the listing companies are in the driver's seat. They have all the leverage, and they've used it to whittle commissions down to as little as 1.1% on the Facebook deal, as you can see here. Morgan Stanley, for example, was paid $68 million to lead manage the Facebook deal, and it may sound like a large number. $68 million is hardly chump change, but it's not a windfall when you think of all the man-hours Morgan Stanley had to pour into winning the bake-off against the other Wall Street firms, and then running the roadshow, meeting, introducing Facebook executives to investors around the world. And put it into perspective, it accounted for only 7.5% of Morgan Stanley's equity underwriting revenue that year, and less than 1/4% of the firm's revenue in total.
But 7% of the equity underwriting for the year, I mean, we'd have to compare what the other sort of equity underwriting was comprised of and how big it was in comparison to other years to know what that really means. But it's not nothing.
No, it's not nothing. But if you think about all the hype and all the excitement behind deals like Snap, it is surprising, and the competition that goes into winning them. Snap isn't raising as much money as Facebook did, and so it's not going to pay as low a commission. It's probably going to have to pay something in the order mark of, say, 3 or 3.25%. So that's going to generate total commissions in the order of $100 million. Again, it's not small change, but that $100 million is going to have to be split by 12 banks lead and co-managing this offering.
Why? Why the competition and why bother?
Well, I'm not sure exactly how to order these things because you might think to yourself that ego should be at the top of the list, but I'll put it at the bottom of the list. I think the number one reason these banks are so hot to trot for big IPOs like Snap is the need to meet institutional demand. Remember, they represent people on both sides, the listing company and the investors who buy the stock. So there's lots of institutional demand for IPO shares. Many investors want to flip them and make a quick profit. Others are going to be long-term holders. But that relationship is increasingly important for these banks in a regulatory environment like MiFID II, Mark, for example, in which trading firms have to justify their value to clients. Number two, I would say, is the ongoing corporate-client relationship, in this case with Snap. Snap has needs for other things that Wall Street banks can offer, maybe another equity offering, a secondary. It could want to raise debt. You need to turn to Wall Street for the most part for that as well. And then there are cash management activities for which a firm like Snap will also pay commissions. And finally, like I said, you can put it at number one or you can put it at number three. There's the prestige factor. This is Wall Street, after all. These firms want to be seen as winning the business because, in most people's eyes, the winners are doing something right.
So prestige aside, how good a business is it, Erik, equity underwriting?
Equity underwriting, Mark, is in secular decline. I hate that term, but I'm going to use it for the moment. If you look at a chart illustrating equity underwriting fees earned by the largest firms, the largest underwriting firms, that is, on Wall Street, you'll see that over the past 4 years, they have declined. 2016 was not a great year for equity underwriting. It was not a great year for IPOs. We've heard this since 1995. The number of deals being taken to market has consistently dropped. And there are a number of reasons for that. You've heard them all. The growing role of private capital, for example. Why is Uber still private? Because it can still raise money in the private market. Regulation inextricably tied to the growth of private capital. Perhaps even the pace of innovation. We've heard some questions raised as to whether Silicon Valley is minting enough new ideas. But this decline that we've illustrated does help to illustrate the growing importance of somewhat lucrative deals like Snap. Every single dollar counts.